Hello student, this is Professor Faiz Raut from Jain College of Engineering, Department of MBA. I'm teaching subject Legal and Business Environment. I'm in lecture number 4. In lecture 3, we have discussed about Industrial Policy Statement of 1991, and in the lecture number 3, in the ending, I have told you that there are a few reasons why this policy of 1991 was implemented and was taken into existence. And there are few terminologies in which I want to explain this, and as an MBA student you should know what these terminologies mean. Okay, let's start with a few reasons of the okay. So first reason is India had a negative balance of payment. Okay, negative balance of payment, if I could explain in one line, it means the outflows from the country were more and the inflows in the country were very less. So India was facing shortage of foreign currency, and India needed foreign currency in order for its exports. Its major exports being crude oil. So as the balance of payment was very negative at that time, so it had a very it was a very crucial time how to improve this balance of payment. Well, if I can tell you, this balance of payment problem is still existing, and but nowadays it is manageable because our exports are also fairly good. Okay, so but at that time the balance of payment problem was a huge problem. So this is one of the reason why the 1991 industrial policy was implemented. And the second reason is, in addition, India suffered payment crisis during 1991-1992. Why the payment crisis was there? India's major import was crude oil, and because of the Gulf War, which was taking place between Iraq and Kuwait, and the US intervention, so all those disturbances in the Gulf region, which is the major supplier of oil, was there. Okay, so because of those disruption, the oil prices went up, and because of that, India couldn't pay the pay for the oil, for the crude oil, and because of this, the payment crisis happened in 1991-1992. So the imports were becoming very costly. Okay, so next is, foreign exchange reserves of India declined from 3.11 billion US dollars during August 1990 to 896 million US dollars. So from 3 billion, we came down to 0.8 billion, if I can tell, in January 1991. So because of this, import of crude oil became almost impossible after a few months. Okay. Next is, apart from these reasons, some policy prior to 1991 were also unfavorable. We have discussed these policies, the problems which were there because of the licensing Raj and the unfavorable economic situation and the huge regulatory restrictions and all those things we have discussed already. So to overcome all this, the Indian government approached the International Monetary Fund for some relief package. Okay, so India got this relief package under some conditions. This condition was first condition and the basic one, which was to open the economy for the world. So Indian economy was more or less the closed economic system. So IMF suggested that India should open up the economy, reduce its tariff, reduce its import duties gradually. So only then they'll help India in this situation. So the World Bank and the International Monetary Fund both helped India and gave some relief package, a kind of a loan. Okay. So this was some of the reasons by which the 1991 industrial policy was implemented, and many transparency and many good things happened, that transparency improved, and the development of the economical situation, development of many industries started taking place. Entrepreneurship was encouraged, private participation got increased. Okay, the standard of living started increasing, and many such things happened. And there are few terminologies which I want you to know. Well, this is not part of the syllabus. If you are studying for exam, you can skip this part and you can see it later on. Okay. Okay, let's go to some terminologies. First terminology I want to talk about is business budget deficit. Okay, even in 1991, India faced a budget deficit. Now, what is a budget? Budget is the amount which is being required, which has been prepared by the finance ministry of any government. The budget tells what are the budget defines what are the incomes from taxes to the government, and from those taxes what it plans to what are the plans of expenditure for the year to come, for the next financial year. So India faced a budget deficit. What do you mean by budget deficit? A budget deficit occurs when the expenses, what is being planned, exceed the revenue, okay, and indicate the financial health of the country. The government generally uses the term budget deficit when referring to spending is more rather than the revenue. Okay, and this budget deficit problem is sometimes it hampers the revenue of the government as well and the Indian treasury as well. Okay, so budget deficit, I hope you understood this. Okay, next one is a trade deficit. Okay, trade, I mean, there are two things in this: import, export, and entry port trade. Also, we have studied, but mainly it focuses on import and export because it is the actual trading of goods and services happening. Okay, so a trade deficit occurs when the country's imports exceed its exports during a given period of time. It is also called as a balance of trade. Okay, so the balance of trade is negative. That means the trade is in deficit. Our imports are more. Okay, we are paying in foreign currency and we are importing goods, minus we are getting foreign currency and we are exporting, we are selling our items. So if our foreign currency is depleting, we are in the trade deficit. So, well, top import of India are crude oil, gold, electronic goods, machineries are required for value for various industries are the main imports. Whereas the top exports of India are petroleum products, gems, jewelries, pharmaceutical products, etc. So, from these imports of India are high still now. Okay, this amounts to trade deficit. Okay, next is current account. The current account represents the country's foreign transactions, which are much more visible and which takes place within a quarter or within a year. Okay, so the current account also includes the balance of trade, which we did in the previous slide. So there are three broad components in current account. First is balance of trade, net factor income, okay, and net transfer payments. Net factor income may include the income which is being generated by the country's labor or the NRIs. Okay, what is the income which has been generated, and what are the payments, net transfer payments for maybe some aid we are getting, or some payments we are giving to the foreigners in our country who are sending those repatriated amount to their country, and all those payments and all those transfer of money which takes place within a year or within a quarter, which is quite visible, that comes under current account. Okay, next is capital account. Capital account includes the flow in and out of the capital account, represents the changes in the values of the assets through investments, loans, bank balances, real property value. See, in current account, we were dealing with the cash transfers, which takes place immediately and which is very visible. Okay, in capital account, we will cater through the investments or loans which are long term, the bank balances, the property value of a person who is the resident of India but having property abroad. Say all those things will be included in capital account, and these are not immediate like current account. And some investments by foreign countries which are included also included in this account. For example, US has invested $25.6 billion between April 2000 and March 2019. So in this 19 years, US has invested $25.6 billion. So this will not be taken into current account. This long period of time, 19 years, this amount will be taken under capital account. And one more example, UAE has recently, last 3-4 months back, has committed 75 billion US dollars, 3 times what US has invested in this 19 years. UAE has committed 75 billion US dollars investments in India's infrastructure sector. And also one more news you have heard, I wanted to mention this. Aramco, which is a company a company in Saudi Arabia, is planning to invest a 20% stake in Reliance. So it is and Saudi Arabia as a whole is planning to invest 100 billion US dollars in the area of energy, refining, petrochemicals, infrastructure, agriculture, minerals, minings. So India is a good investment hub, is becoming a new investment hub, and this is accounting to capital account. So we have done three things. Okay, first was trade deficit, okay, which was imports minus export, or exports minus import, whichever is higher. So if imports are high, it is a deficit. Then we did about current account, okay, which is the real transfer of payments within a financial year. Then we did capital account, okay, which is the long term investments or long term inflows and outflows of money. So including all these three, we reach to a term which is balance of payment, which I told you in the first slide. Okay, you came across with this word. So balance of payment is a statement of all the transactions made between entities of one country and the rest of the world over a period of time, such as a quarter or a year. Now, in this balance of payment, current account is definitely included. So, the trade balance of trade is also included in this, and along with the current account, capital account is also included in this. By adjusting it, how much the revenue is being generated by the investment within a year. So considering these two, the balance of payment, the final figure, it is like a balance sheet of a company, okay, is being calculated. And if I want to tell you, the balance of payment is being negative from 1991 till date. In the year somewhere around 2000 2002, once or twice the balance of payment was positive, because we were taking some loans from the institutions, foreign institutions. But more or less, the balance of payment has always been negative, and this is the net account actually of all the transaction in both capital and current account. Okay, and the balance of payment and international investment position data critical in formulating national and international economic policies. Well, these are the some of the terms which I thought you should be knowing as an MBA student. Well, there are many such terms I wanted to explain you. This was all about this lecture, and thank you for your patient listening.